Hello, I'm going to be talking about retirement income streams today. Basically, the main streams or main sources of income once one has retired are the employer's pension scheme or provisions which one has made individually, in other words, privately. To start off with the employer pension schemes, now these schemes provide benefit in recognition of the employee's long and faithful service. The employer administers the scheme. And it gives a sense of security to the employees. The scheme itself can be non-contributory or contributory, meaning the employee may be required to pay a premium, make a contribution, and also it may be related to the salary. In other words, it's dependent on how high the salary is that the pension is provided. The benefits available include a commutation of the pension fund. What that basically means is that part of the pension is payable in the form of a lump sum, usually tax-free. Now there are limits as to how much of the fund can be taken as a tax-free amount. If the individual is entitled to gratuity, then the maximum tax-free amount is 1/3 of the pension. Whereas if the individual is not entitled to any gratuity, then up to one half of the pension fund may be commuted. As I mentioned, the tax treatment of the cash amount taken is dependent on whether or not it has exceeded the maximum 1/3 and 1/2 as mentioned earlier. The annuity, on the other hand, that is to say, the remaining amount of fund is used to provide a pension, and that pension is taxable. It's taxable just like salary. So let's look at the tax provisions for the main sort of benefits: the Employee Provident Fund benefit, the Gratuity benefit, and any approved Superannuation Fund benefits. So let's look at the Employee Provident Fund scheme first of all. The up to 12% of contribution may be paid by the employee. And the employee's contribution is exempted under Section 80C. The employer's contribution is, of course, tax-free. As far as the benefit is concerned, in other words, the fund which is payable is tax-free also. Now, if we look at the any approved superannuation fund, any up to 27% less contribution paid to the EPF may be made by the employee. The employee's contribution are again exempted under Section 80C. Also, the employer's contribution is exempted. As far as the benefit position is concerned, the commuted amount is mentioned. The tax-free amount has already been mentioned, and also that the pension payable is taxable. With regard to the gratuity fund, the amount of gratuity payable, the amount of tax-free gratuity payable, of course, depends on certain limits, and the contribution is mainly payable on the whole payable by the employer, as there is no employee contribution involved. Now, moving on to the private provision which an individual would make towards his own pension, these would be mainly based on immediate and deferred annuities. An immediate annuity is where an annuity is purchased and it's payable almost immediately following the term, the deferred period. For example, deferred period in this particular case may be 1 month, or if the annuity is payable quarterly, then it starts immediately after that, after 3 months. The post office monthly income scheme and the post office quarterly income schemes are examples of immediate annuity. Now, deferred annuity, pure deferred annuities, are where a period of savings is involved. For example, it could be that the annuity is deferred for a period of 3 years, 5 years. So only after an accumulation period of 3 or 5 years does the annuity come into force, and the benefits are paid out. The premiums or the purchase price for the annuity can be either in the form of either a lump sum or regular premiums. The different types of annuity plans are quite varied. The usual ones are annuity for life, annuity certain and thereafter for life, annuity certain with return of purchase price, annuity for life with return of purchase price, a joint life annuity, and also joint life annuity with return of purchase price. To explain a bit more, an annuity for life, for example, would be where the annuity, once it's purchased, is payable throughout the lifetime of the individual. An annuity certain, on the other hand, is where the annuity is only paid for an agreed period of time. If the annuitant lives after that period, then no further payment is made. An annuity certain and thereafter for life would cover someone for a fixed number of years, a guaranteed number of years, and then annuity for however long it lives. As far as joint life annuity is concerned, that's of course usually on the life of two individuals, for example, husband and wife. And so if one person dies, then it carries on for the other person. So this actually is called joint life last survivor annuity. Apart from these two main streams, namely the employer scheme, pension scheme, and the annuity, which is privately purchased, the other streams would come from income streams would come from fixed deposits, from company fixed schemes, from deep discount bonds, from RBI relief bonds, or from post office schemes. So let's look at them one at a time. As far as fixed deposits are concerned, now this is the simplest form of savings which everyone understands, and it's also a safe form of saving. Usually the minimum period for the saving is about 30 days. In other words, the minimum period that one can leave an amount with the bank, deposited with the bank, is about 30 days. And the maximum amount usually varies from 5 years to 8 years to up to 10 years. However, the one disadvantage is, bearing in mind what is happening in the investment market, is that the return on such deposits is fairly low. The good news, however, is that the investment in a bank's fixed deposit is exempted from income tax under 80C, provided it is fixed for 5 years or more. Next, let's look at the company fixed deposits. This would be a similar sort of scheme to the bank scheme, except that the deposit is with a company. The returns are higher, can be up to 12.5%. If the interest earned for deposit at any one time exceeds 5,000, then tax is deducted at a certain rate under TDS, usually up to 10.3%. Note that if a deposit is prematurely repaid, the company may reduce the interest rate depending on the particular company, and it can be up to 2% reduction. As far as deep discount bonds are concerned, these are also known as zero coupon bonds. Now what happens is, also sometimes called growth bonds, growth and accumulation bonds. What happens is, instead of the return being passed over to the investor on a regular basis, it's accumulated and is paid right at the end of the term of the investment, together with the return of the original investment. Similarly, the RBI relief bonds, these are long-term instruments with fixed returns, predetermined returns. For example, the 2003 8% savings bonds. Now, post office schemes. There are several post office schemes. These vary from the National Savings Certificate through the Public Provident Fund to Kisan Vikas Patra. Also, post office. There is the post office monthly scheme, post office savings deposit, term deposit, recurring deposit, and also special schemes for retiring government employees. Let me talk a bit more in detail about the post office schemes itself. These are monthly schemes as well as quarterly schemes, which can be used to provide retirement income streams at a later age. The investment limit for the monthly income scheme is minimum of 1,000, and additional 1,000 can be paid in multiples of 1,000, in other words. The maximum amount of investment is 3 lakh if it's a single account, however, if you're a senior citizen, in other words 60 or above, then for a single account the maximum amount is 15 lakh. In addition to the monthly income plan, there is also a quarterly income plan which is offered by the post office. The rate of interest or the rate of return on this particular investment is 9% per annum, as opposed to 8% per annum on the monthly scheme. The schemes can be taken up by a single individual, or they can be taken up jointly with 2 or more individuals. A minor can also have an account together with a parent or a guardian. The term of the investment is 6 years. However, for a senior citizen, the term is 5 years only. The principal amount is returned on maturity, together with the interest earned. There are no tax benefits as such in terms of relief under Section 80C. The monthly or quarterly income would therefore be taxable.
Let me also talk about the National Savings Certificates. The minimum amount of investment under such certificates is 100 rupees. Additional investment in multiples of 100 may also be made. There is actually no maximum amount. In other words, there is no limit to what the maximum amount of investment can be. The mode of operation, well, single individual can open the account or buy the certificate, or it can be in joint names. Also, it can be in the name of a minor with a guardian or a parent. The maximum term of investment is 6 years, and on maturity, the certificate can be encased and cashed from the issuing post office just by signing on the back. One advantage of such certificates is that it is easily transferable. In other words, there can be a change of name just by registering the transfer. Another advantage, if you like, is that the loan may be taken, and banks are prepared to hand out up to 75% of the face value plus any accrued interest. With regard to tax benefits are available in respect of Section 80C, and interest accrued for any particular year can be treated as a fresh investment under 80C, and therefore relief can be claimed. However, for the final interest earned on the certificate, there will be no exemption from tax. I'd like to stop there, so thank you.